Okay, today we're going to be talking about the behavior of exchange rates. So, what models do we have that can predict how exchange rates behave? We're going to develop two more models, building on the long run approach from last time. Again, the long run means that there's a sufficient amount of time for prices to adjust and for markets to meet their equilibrium. So these are not intended to be completely realistic descriptions. After all, it is a model. So we have the law of one price. This states the same good in different competitive markets must sell for the same price when transaction costs and barriers between those markets aren't important. And the reason that this is why is because there will be a sufficient amount of arbitrage opportunities that will bid the prices equal to each other. So, due to the price difference, entrepreneurs will use arbitrage. So, consider a pizza restaurant in Seattle and one across the border in Vancouver. The law of one price says that the price of the same pizza in the two cities must be the same if markets are competitive and transportation costs and barriers aren't important. So we have the price of the pizza in the US equals the exchange rate between US and Canadian dollars times the pizza price of the Canadian pizza. Another thing we have is called purchasing power parity. It's an application of the law on one price. So we have price level in the US equals the exchange rate times price level in Canada. This implies that the exchange rate is determined by levels of average prices, where the exchange rate equals the average price in the US divided by the average price in Canada. So this predicts that people in all countries have the same purchasing power with their currencies. Canadian dollars buy the same amount of goods as a US dollar. We have two forms of this: absolute purchasing power parity. This is what we just discussed. Then we have relative purchasing power parity, which is changes in exchange rate equal changes in prices or inflation between two periods. So that's what that looks like mathematically. And in this case, pi sub t is the inflation rate from period t minus 1 to t, or in plain English, pi sub t is the inflation rate from the period before to the current period. So, we have a monetary approach to exchange rate, which uses monetary factors to predict how rates will adjust in the long run. This is based upon the absolute version of purchasing power parity. It's a predictive tool. So we have the average prices in the US equals the money supply in the US divided by that function of return on non-monetary assets and income. To the degree that purchasing power parity holds, and to the degree that prices adjust to equate quantity of real monetary assets supplied with the quantity of real monetary assets demanded, we have the following prediction. So, if we have permanent rise in domestic money supply and a proportional increase in price level, causing depreciation in domestic currency, interest rates. A rise in domestic interest rates lowers the demand of monetary assets, and there's a rise in domestic prices, and we have a proportional depreciation of domestic currency. output level, a rise in domestic level of production and income, raises demand of monetary assets. And we have a decreased level of average domestic prices. Then we have a appreciation of the domestic currency through PPP. So a change in monetary money supply results in a change in level of average prices. Change in the growth rate results in a change in the growth rate of prices, or inflation. So we have the Fisher effect. This is named after economist Irving Fisher. It describes the relationship between nominal interest rates and inflation. So it's derived from the interest parity condition, where we have return on US dollars minus return on euros. So what this says is that a rise in domestic inflation rate causes an equal rise in the interest rate on deposits of domestic currency in the long run. And ceteris paribus. Suppose that the central bank unexpectedly increased the growth rate of money supply at t times 0. We have the inflation rate of pi. According to the Fisher effect, the interest rate in the US will adjust to the higher inflation rate. The increase in nominal interest rate decreases demand of monetary assets. And in order for the money market to maintain equilibrium in the long run, prices must jump so that this equation holds. In order to maintain PPP, the exchange rate must jump so that this equation holds. So let's look at the role of inflation and expectations. In the long run model without PPP, changes in money supply lead to changes in the level of average prices. No inflation is predicted to occur in the long run, but only during the transition. We have expectations of higher domestic inflation cause the expected return on foreign currency deposits to increase, making the domestic currency depreciate. In the monetary approach with PPP, the rate of inflation increases permanently when the growth rate of the money supply increases permanently. In the long run model without PPE, the level of average prices does not immediately adjust, even if expectations of inflation adjust. In the monetary approach with PPE, the level of average prices adjust with expectations of inflation. Causes domestic currency to depreciate, but there's no overshooting. So, shortcomings. Again, it's a model, so there's bound to be shortcomings. The first and the major one is that there is little empirical support for absolute purchasing power parity. The prices of commodity baskets differ substantially across countries. Relative PPE is somewhat consistent with the data, but it performs poorly as a predictive tool. So let's look at some reasons why the PPE model might not be accurate. The law of run price may not hold because of trade barriers and non-tradable products, imperfect competition, differences in measures of average prices for goods and services. So let's look at trade barriers and non-tradable products. Transport costs and governmental trade restrictions are a big factor. Services are often non-tradable. So for example, you can't get barber services from another country. So imperfect competition. This is price discrimination. A firm sells the same product in different prices in different markets to maximize product profits. So differences in the measure of average prices. Law of one price for hamburgers. You can see this is called the Big Mac Index. And it's often used a lot by reporters and journalists. So, economists have tried to make a better theory. One of the new theories is called the real exchange rate. It's the relative value, price, cost of goods and services across countries. That's what the formula looks like for that. According to PPE, exchange rates are determined by relative average prices. According to the real exchange rate approach, exchange rates might also be influenced by the real exchange rate. What influences the real exchange rate? Change in relative demand of U.S. products, change in relative supply, and here's what the relative demand, relative supply curves look like. So what are the effects of the nominal exchange rate? When only money factors change and PPP holds, we have the same predictions as before. When factors influencing output change, the real exchange rate changes. So when economic changes are influenced only by monetary factors and when the assumptions of PPP hold, nominal exchange rates are determined by purchasing power parity. When economic changes are caused by factors that affect real output, exchange rates are not determined by purchasing power parity, but they're influenced by the real exchange rate.